All right. Welcome, welcome, welcome. So this is an amazing webinar that we're going to do on Convert the Vert, our number one strategy, also known as Zero DTE SPX, easier to just say CTV, stands for Convert the Vert. What I'm going to do tonight is I'm going to cover the Convert the Vert strategy and methodology from A to Z. I'm literally going to go through everything. Now, for those of you that have never seen anything like it before, have never seen Convert the Vert, you're going to absolutely love it. And even those of you that don't know much about options, I'm actually going to do a little mini options primer so that I can build a foundation so that you completely will understand how this works. And not only am I going to show you the strategy and how it works, I'm literally going to show you Convert the Vert without the workspaces and customized indicators that we use, otherwise known as the rocket ship. I'm going to show it to you with just straight up candles and a couple of moving averages. Literally no special indicators, no software, just price action and a few rules. Because if I could show you the magic of this, methodology and how it works and the strategy, and you don't need anything special. For those of you that want to be able to trade Convert the Vert on your phone when you're traveling, right? So if you've never seen it before, you will leave this webinar with enough information to go out there and make money with Convert the Vert, period. Now, why would I do that? Because I think once you see it, it's so exciting. I'm betting that many of you will want the rocket ship to just make it easier. It's kind of like if I told you to, go to the store and pick up something and come back, and I told you where the store was, I even drew out a map for you and said, go ahead, right? And so you don't have a phone, you don't have GPS, you don't have a car, you've got to walk, find your way, use the map, you get there, right? You do get there, pick it up, whatever, and then bring it back, you get home. But it's going to take you a while, maybe. It's a little bit more cumbersome. It wouldn't be just easier to get in the car with GPS and boom, you get right there. So I'm hoping that some of you might want the rocket ship, okay? But if it's that good, I should be able to show you from A to Z what Convert the Vert is and how it works. It's complete strategy. I'm really not going to leave much out at all. Okay, I'm really going to cover just about everything as it relates to price action, how it works. I'm going to show you 2 trades on it just to show you that I'm not cherry picking. I'm going to do yesterday and today. Literally the 2 trades, just the last 2 days in a row. I certainly didn't collude with the markets yesterday and today to say, hey, give me a good CTV setup in the morning 2 days in a row. So I'm just going to show you what it looked like today. And I'm also going to show you, as I go through everything, I am going to also show you sort of the day trading aspect of it that you can do that maybe is not Convert the Vert, but a way that you could potentially use Convert the Vert to day trade. First thing I want to cover right off the bat is just do a little mini primer on options, okay? So I'm going to just put up a blank screen here. I'm going to try to draw as neatly as possible, but just to kind of give you a little bit of an idea, because if I show you Convert the Vert right out of the gate, we take verticals and we convert them and we make butterflies, and someone says, well, what's a butterfly? And like, what's a vertical? What do you mean? Like a bull put spread or call, right? So wouldn't it be better if I just kind of gave you a nice primer just to start with? So that's what I'm going to do. So first things first, stock versus options. Really simple. If you were to buy, let's just say, a $300 stock, okay? The stock itself, whatever it is, ABC stock, and you were to buy 10 shares of it, that would cost you $3,000, okay? And let's just say you held the stock for a week or a week and a half, it could be longer, and the stock goes from 300 to 310. Nice move, right? So obviously, you've got a $10 move times 10 shares, so you made $100. So $100 profit in about a week, that's not bad, except for the fact that you had to spend and risk $3,000 to make 100. Now that is not a good risk reward ratio. But some people, like trading stock, and you could certainly trade 100 shares if you wanted to. But again, if you traded 100 shares and it cost you, $30,000, whatever it is, you would only be making in this scenario about 3.3% profit. So options gives you leverage in a way that stock cannot do. I'm going to give you an example of how options work. There's two types of options. There's calls and there's puts. Calls typically are an options contract that if you are looking for the stock to go up in price, you buy calls. If you're looking for the price to go down, you buy puts. That's just what they are called. Forget about what it means. That's just the name that is used. An option is nothing more than a contract, and it gives the buyer of the contract the option, which is why they're called options. It gives you the option to take delivery of the stock. So one options contract, and let's just call it call options. Remember, I said calls. Call options are when you want price to go up. One call option is a contract, and it represents 100 shares of stock. Now, you don't own it. You own a contract that gives you the option to take possession. Now, because it's a contract that represents the 100 shares, it's not going to cost you anywhere near $3,000. As an example, let's just say, these are not real numbers, right? But let's just say that the call option, I'm going to just pick one here. Let's just say I'm going to pick the 304 call. Okay, so what does that mean? Well, when you pick an option, you have to pick the strike price. That's what this is called. You could buy the 300 call. That's at the money, right at the money. Which means if you were to sell that call, you would end up probably with the same amount of money that you paid for it, so you don't make any money. The price would have to move higher. The 304 call is considered out of the money. And it doesn't really matter that you understand completely what this means. Those of you that do, you're following. And those of you that are brand new, just understand that the contract here for the example is a contract for 304. Which means at any point in time between now and the expiration date, which is the second thing I have to pick, I have to decide when it expires. And most options contracts, there are others that have different dates, but most of them expire on Fridays. That's called a weekly expiration. There are some that are monthly, some are bi-weekly, and some are daily. Let's just focus on this for now. So you have to pick a Friday. So let's pick next Friday. Okay, so I'm going to pick next Friday, which is the 22nd. That's the expiration date of the contract, which means if I want to take possession of these shares, I have to exercise my right. Now, how does that work? Well, if I exercise my right, it means I'm going to buy them at 304. So what if price goes up to 308 or 309? It might make sense. If I want to own the stock, wouldn't it be good for me to exercise this call option, because then I could own them at 304 because that's what my contract says. So I could do that. So if price goes up from 300 to 305, 306, 307, before my expiration date, I could say, okay, Mr. Broker, I got these 304 calls, right? I got one contract, 100 shares. I'm going to go ahead and exercise that right now. He says, okay, we're going to take $30,400 out of your account so that you end up with 100 shares. I go, great, because this is actually worth 30,700, right? 307 as the price of the shares go up to 307. So I'm already going to be up $300. So I might do that. But in most cases, most Retail investors like me and you, we don't do that. What do we do? What we do is we flip it. And you all are familiar with flipping contracts. So it's pretty simple. If I buy a 304 call options contract, one single contract, and it costs me, let's just say $3. This is how it's priced. Now, it's not actually $3 because there's 100 shares. So it'll show up as $3 on the options chain when you go to buy it. But we all know that at $3 in options world means 300. So now I've got control over 100 shares that I could take possession of if I want to, and the contract cost me 300. Now, if price goes up, just like it did in example number 1, it went up to 310. So let's just say the same thing happened here. Price went up to 310. The way you calculate the value of an option is you take the current price, wherever, let's just say at expiration. Let's just say it's Friday, the 22nd. Price has gone up, price has gone down, and finally it finishes exactly where we said it did here in example number 1. It finishes at 310. The simple math is you just subtract the the strike price of your contract from the actual price. And what do you get? You get $6. So my options contract at expiration, let's just say it's worth $6, which is a $3 profit, right? Didn't I spend $3 to get the options contract? Actually, it was $300. Now it's worth $600. So if I flip the contract, what do I make? If I bought it for $300 and I sell it for $600, remember we just did the math here. Real price minus the strike of my contract means I made $300. So if I made $300, as an example, off of a $300 cost, that is 100% return on my money. This was $3,000 where I made $100. In this scenario with options, I made 3 times the money, really, but actually in percentage of what I invested, I made 100% on my money. This is called extreme leverage, incredible leverage. Okay? So does everybody understand the logic behind here? Leverage. So some people will tell you options are so much more risky. Well, if you play certain option strategies that are very risky, yes, just like anything, there are. But we don't teach any of those, and most investors don't utilize those. So with this particular type of options trade that I just showed you, when you buy the options contract for $300, the most you could ever lose is the cost of the contract. So I want to explain one little piece. This will be very important for you to carry through the rest of the presentation. If price went up to 305 here, and your strike price was 304, then you made $100. Well, it cost you 300, so you only made 100. So what happened? Well, you lost $200, right? If price went to only, you were right. Price went up, but it only went to let's say it only goes to 304 as an example. The actual price of our option, of our strike, it went up. It went from 300 to 304, but you own the 304. That means it's worthless. It's not worth anything. So if it was worth 305, you made 100. If it was worth 306, you made 200. But the idea here is if price doesn't go above not only your strike price, but also the price that you paid, in other words, your break even, you're either going to lose money or what we call the option expires worthless. Okay, so you bought the 304, and let's say price only went to 300. Well, it's not worth anything. And the reason why the contract isn't worth anything is if you're owning a contract for 304, but price is sitting down here at 300, Who in their right mind on expiration day is going to want to buy your contract at 304? Nobody, because it's not worth 304 any longer because price is this, 300. That's called when the option contract expires worthless. And what did you lose? You lost your $300. So this is how call options work. Put options work in the reverse. And all that means is if you thought price was going to go down, maybe you would buy the 295 put. And now you want price to go below 295. The math is exactly the same. It's just down versus up. It's called a put versus a call. I'm not going to get into all the details of that. So again, when you are looking to buy an option, you have to pick a strike price, which we did, which was 304 in this particular scenario. We also picked next Friday as the expiration date. And the idea is to close it or flip it before it expires. If you flip it on the same day that you bought it, that is called a day trade. Just to put that little nugget in your brain. Okay? So the break even, just so that you're clear about this, because I want to get into verticals. The break even, if you were to buy the 304 call and it cost you $3, your break even is 307. Price would have to go to 307 for you just to break even. That is your BE. But I want to compare this to a vertical. So I'm going to show you what a vertical looks like and then compare it, how that would work. I'll just add just a couple of notes here on the call. And that is, you could be right. Remember, price was at 300. Price could go up. You could be right, but you could still lose money, right? Because if you don't get past the break even, if it went to 300 to 307, you didn't make any money, did you? So you can be right and still lose money. So you need to be not only right, you need to be right away. It needs to happen quickly before expiration. And you need to be right by a good amount. In this case, in order to make any money, you'd have to be right by $8 or more. Because if it went to 308, you'd make $100. If it went to 309, you'd make 200. If it went to 310, you'd make 300, like we said before. So you really have to be spot on right in the direction, right with the velocity, has to happen quickly, and it has to go up quite a bit in order for you to make money with calls. And that's why buying calls is tough. And most professional traders don't buy, unless they're buying hundreds of them, thousands of them at a time. They don't buy calls, they buy verticals, which I'm going to show you next. So before we talk about the verticals, let me just talk about what it is that's buying a call, right? This is called selling a call. Now, this is not something that you would want to do. This is called selling naked, but I'm going to just show you the example of it quick so that you can understand what it is like to take in premium and what happens when you sell an option. Okay, so if you think the stock is going to go down, one of the things that you could do, and again, this is not something that we teach because it's very dangerous, very volatile, and the losses are pretty much unlimited. So you want to be careful with this kind of strategy. I don't teach it, I don't do it, but I want to show it to you from a standpoint of what premium looks like. So what happens if you went to sell the 306 call because you thought price was going to go down? And you were able to get $100 credit. Let's say it's $1. So you were able to get $100 of premium by selling that call. So let me explain something. There is a market maker, and that market maker facilitates the buying and selling. So there's somebody in wherever that wants to buy the 306 call. Maybe that was me from the prior example, right? I want to buy it. I am a buyer. The market maker finds someone else in the market. It could be a person, it could be an institution, it could be an asset manager, it could be a fund, it could be computerized, whatever. But the market maker will find someone that is selling the 306 call. They may want a certain price for it. I may want to pay less for that. And there's a negotiation back and forth. There's called the mid price in between what they're looking to sell it for. That's called the ask. What I want to pay for it, that's called the bid. There's a bid and ask. The market maker negotiates in a matter of seconds and helps facilitate it. So when you buy a call, you're actually buying it from someone or some entity that is selling it. So let's say this cost $100. The 306 cost $100 and I bought it. I bought the 306, right? The market maker sends the money through brokers and everything else to this person over here that sold it. So they get the $100 in their pocket. It's a transference of me who buys it to the person who sells it and the market maker in between. Okay, that's kind of how options work. And the idea for me here is as long as price stays below 306, in fact, if it continues going lower and lower and lower, this 306 contract will be worthless. Do you remember when I said to you in the previous, I think it was, what do we have, the 304 calls in the other example? Remember when I said if price never makes it to 304, if price finishes at 300, there's no value, so it expires worthless, and you lose the $300? Remember that example before? Well, guess what? In this example here, if someone bought this 306 call for 100, you were the seller, and price stayed below 306 and it expired worthless, you get to keep the $100. They lost $100, just like this person, remembered before, lost the $300 when they bought that call. Somebody made that 300 on the other end. And that's what this is. So if you were to sell a call for $100 and price stayed below that strike price, it would expire worthless. You would keep the $100. Okay, this is just important to understand. When price closes below the strike, it's worthless, whether it's a call, selling a call or buying a call. If you are the seller, you get to keep that premium that you sold it for. If you're a buyer, you would lose that money unless it was a profitable trade. And that's buying and selling calls. Now I'm going to show you vertical. I can't show you convert the vert without talking about verticals. So you could buy a long call, vertical. And it has several different names, but you could. And so what is a vertical? Well, a vertical is when you buy the long call for, let's say, 304, like before. And let's just say the cost, let's just say the cost of that call is $300. I think that's what we said before, right? It's $300 cost for the call. But the vertical is selling a higher priced call above it. And we're able to bring in some premium. Let's say for the 306, I could get, say 220. I'm going to put the dot here just so this makes sense, right? So you buy it for $3, and this one you could sell for 220, but it's done like this. You're going to see me do this a lot. That's a vertical. It's just what I use, right? So if I paid $3 for the call that I bought, and 2 strikes above, I sold the call above it, all done in one transaction. The net transaction is 80 cents or $80 cost. Look how my cost went down. Buying the 304 call like I did before for $3, or I could buy it in a vertical and it only cost me $80. So let's just take a look at what the result of that would be and compare to a vertical to a straight up call. So here, the break even on this particular strategy is you would take the 80 cent cost and you add it to this call here. So your break even is 304.80. Right? Because if price finished at 304.80, what would you get paid on the 304 call? you'd get paid 80 cents, wouldn't you? 304.80, you'd make $80. And the cost was $80. That's why 304.80 is your break even. Okay, that makes sense, right? And over here in this scenario where I bought, what did we buy? We bought just the 304 call straight up, and it cost $3. Okay, this is break even. The break even for this trade over here is 307. So can you see, price could move up and I could lose money spending $3 on that call. But on the vertical, I could actually make money. So let's just do a couple of scenarios real quick. Look at this. Let's say price goes up to 305.50. Well, if it goes up to 305.50 and my break even was 304.80, I made $70, didn't I? Well, if I made $70 on an $80 cost, let's just circle this here, right? That is about, 87.5% profit. In this same scenario, though, 305.50, if you look over here, that means I lost $150, didn't I? Because I spent $300 on it. So 305.50, I'm down $150. So I lost $150. This vertical, they made 70. Let's keep going. What if price went up to 306? Price went up to 306. Look, I'll do short math here. Take the long call right here, the 304, subtract it from 306 like we did before, and it makes $2. That's $2 gross, right? Minus the 80 cents. So I made $120 on this. Well, with an $80 cost, that's 150% profit. Spend $80 and made 150% profit. In this scenario, though, if it only went up to 306, I lost $100. I still haven't made money, right? Because my break even is 307. That's why with the call side, you need explosive, greater than expected move, and it has to happen fast, and it has to be large enough of a move to make money. With a vertical, you can be right on the direction, but it doesn't have to be explosive, and it can take its time, and your break even is a lot lower. So this is just the kind of the beginning ideas of how a vertical works. You can sell the higher priced call for a premium here at the same time that you bought this one. It brings down the cost, which is really cool. Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.